So here we go. You've read through the entire paragraph with Ray. You've made note of Ray's gross income and his friend's gross income. You put them down. Now, like I was saying, we need to add their above the line deductions. Now, the only person that has an above the line deduction is his friend. All right. Interest paid on a student loan can be deducted right from your gross income. So for his friend, we can take away that 850. All right, we're going to subtract that. So that's a good thing. You always want to lower the amount of income. All right. Now, for Ray, he had none of those. So we're just going to subtract 0 and then come up with our next values. So Ray, his adjusted income is going to be staying at 45,000, but his friend, that adjusted income drops down to 12,050. Okay. So because his friend was going to college and he had a loan out, he was paying interest on that loan. So the more interest you pay, you could actually take that away from your gross income. So that is a good thing. All right. The next thing, now that we have our AGI, which is our adjusted gross income, you could take two different types of deduction. One, you could take a standard deduction, and a standard deduction is, I'm going to write that down. Standard deduction right now for 2020 is going to be 12,400. Okay, that's what a standard deduction is. Everybody has the opportunity to do that. That's if you are filing single. Okay, so we'll just assume Ray and his friend are both single, and they are both given that deduction. Now, you have another option. Instead of taking the standard deduction, you could do an itemized deduction. So there's two things that can be considered as itemized deductions. And Ray's got him. It's for his property taxes and also the interest that he paid on his mortgage. So he has a home, and to live in that neighborhood, you have to pay the property taxes. In this case, it was 6,100, and then he also paid interest on his mortgage loan for his house that he was paying for. So if you take those two values, all right, take 6,100 and 7,200, all right, add them together, you're going to get 13,300. Okay, now that sum could be used as a deduction. All right. In this case, Ray is going to want to use the itemized deduction. Okay, itemized deduction, rather than the standardized deduction, because the standard deduction is 12,400, but his is 13,300, which is better. Remember, you want to take away more money from your reported income. So once you subtract it like that, then Ray's taxable income will end up being $31,700. Okay, so he lowered how much he gets taxed on it. He used to get taxed on 45,000, but with his itemized deduction, now he can only be taxed on 31,700. And in Ray's friend situation, he didn't have a house and he didn't have anything that he could itemize, so he's just going to go with the standard deduction that everybody gets, and that's going to be 12,400. That was for the year 2020. So if you do that subtraction, then the taxable income for Ray's friend is actually negative 350. So what that really means is that Ray's friend has $0 that he could be taxed on because the deduction brought him to a negative value. And that's what will happen probably for a lot of teenagers that maybe have a job that pays them less than 12,000. Where's the standard deduction? If their job pays less than 12,400, when they use that standard deduction, assuming they're single, they would put them negative in taxable income. So then they wouldn't even owe any taxes. Okay. So speaking of that, the taxes that are owed is going to be $0. Okay. I'm going to keep going here. His friend has no other things going on. He has no tax credits that he could use. So then well, let me put that in blue, actually. Keep this. There you go. No taxes, no tax credits that he could take away, and he doesn't need to because he doesn't even owe taxes. So the taxes owed at the end ends up being $0. Okay. All right. I'm gonna stop there. So he owes no taxes. Ray, however, he does owe taxes. Okay, they could tax him on 31,700. Now there is a way to calculate these taxes, and I am going to just make a value up. All right, I'll show you how to calculate the taxes in another video, but I'm just going to make this up or think about what it would be about, and that is let's see, about 3,175. So let's just say of the taxable income, they hit him with a certain percentage, he would end up owing in taxes $3,175. Now, does Ray have any tax credits? Well, if you have one child, there is a child tax credit of $2,000 per child that you have. So Ray has one child, so then he could subtract from the taxes owed 2,000. And this is awesome because that just takes away directly from how much you owe. It's not deducting or lowering the amount that you could be taxed on. You're actually taking away from your bill $2,000. So then once you take away that 2,000, Ray is left with owing, I believe that is $1,715. So that's what Ray owes in taxes. Now, his employer at the golf course has been taking out taxes throughout the year, okay? Because you don't want to just, show up in the spring and say, "Oh, I've got to owe these taxes," because then Ray would have to write a check for $1,715, and that would not be cool. So Ray's employer has held out 3,900. So what we're gonna do is now subtract 3,900. Okay, that was the taxes withheld, and let's see what that comes up with. All right, that ends up giving us a negative 2,185. So now Ray is going to be refunded this much money. All right, he's getting a refund. Okay, because remember he owed 1,715 after he calculated it. Now, his employer was taking out a bunch of money. He was assuming Ray would probably owe, 3,000 something taxes. In this case, Ray owed 3,175, but they never took into account that he had a kid, which gave him credit for some of his taxes. And now his employer just took out too much, and he ends up getting a refund of 2,185. So it's awesome. It works out really well. For Ray's friend, the employer also took out money. His friend was made much less than Ray. He was making 12,900 compared to Ray's 45,000. So his employer only took out 1,290, but that's good because when you subtract that from zero, you're left with a negative 1,290. And that is also a refund. So that's what happens to a lot of people that are making money and it's less than that standard deduction. They end up not really owing any taxes. And then if their employer was holding out money, they get all that back because they didn't know. All right. So that is, those are two examples of how you would calculate how much taxable income that you would have, as well as if you would potentially get a refund or not, or owe more. I should say, now that I said you might owe more, let's say if your employer didn't take out enough, Ray owed 1,700, 1,715. Let's say employer only held out $1,000. So then if Ray owed 1,715, well, his employer already withheld 1,000. Well, then Ray would still owe, he would have to write a check for $715. So you always want to make sure you check with your employer and make sure they are taking out money for taxes. If not, you should probably be taking out money for taxes throughout the year so that you're not hit with this big bill at the end. Okay. Any questions on this at all?